Bitcoin is up over 40% in the last 3 months. So why are Bitcoin mining stocks getting crushed lately? Today, I'm diving into crypto mining stocks to see if they might be a good short-term or long-term investing opportunity. And if you're new to the channel, I'm Travis, aka the Stock Geek. I spent a decade at hedge funds investing in public stocks. Today, I manage my own portfolio and help individual investors get smarter about investing. All right, so let's dive right in. Crypto mining stocks are some of the most popular stocks among retail individual investors. They're one of the more direct ways that we can play crypto in public stock markets. Other ways might be things like Coinbase, a publicly traded exchange. You've got MicroStrategy, which holds a bunch of Bitcoin on its balance sheet. The Grayscale Bitcoin Trust, GBTC, which also owns a bunch of Bitcoin. That's one I tweeted about almost a year ago, did a long tweet thread looking at it as a potential investment opportunity when it was trading at about a 50% discount to its Bitcoin holdings. So I'm gonna go ahead and pat myself on the back for that one. It's up almost 200% in the past year, and it's been my primary way to play crypto in the stock market over the past year. But we're here to talk about crypto mining stocks, not about GBTC. When we look at the universe of crypto mining stocks in US stock markets, there's about 10 publicly traded miners. 2 of those, RIOT platforms and Marathon Digital, sport market caps north of $2 billion today, but they have gone through some epic boom and bust cycles. In fact, we've seen RIOT and Marathon start as penny stocks, go on to be multi-billion-dollar market caps, come all the way back down to micro cap status, and then recover somewhat. These have had quite the wild ride, and that's saying something. We know that Bitcoin has also had significant drawdowns, in some cases over 80% drawdowns during its cycles as well, but these miners have some pretty crazy charts. So the question is, what do the miners' performance look like versus the underlying Bitcoin price? And the miners have been in business actually mining Bitcoin since around the 2017 timeframe. So if we look from the start of 2017 through now, Bitcoin's up almost 4,000%. The miners, in many cases, are actually down. Some of them are up, like RIOT is up about 200% during that time frame. Now, we could shift the time frame to start in, say, 2018, when some of these miners got more scale and got more into the business of Bitcoin mining. If we look at 2018 through current day, Bitcoin's up almost 200%, but a lot of the miner stocks are still down. So the question you might ask is, well, do miner stocks ever outperform Bitcoin? You know, I started the video talking about how we had a significant underperformance of the miners versus Bitcoin over the past few months. Now, if we look year to date, however, the miners have outperformed Bitcoin. It's only over the past few months where the miners have once again started to underperform. So we did see year to date the miners outperforming Bitcoin. We also saw during the 2020 calendar cycle that some of these miners were multi-bagger stocks. Some of these miner stocks like RIOT and MARA were 10-baggers or even better in some cases during calendar year 2020. Bitcoin, of course, put up a respectable 260% plus return. Pretty strong bull market for Bitcoin during 2020 and early 2021. But these mining stocks were massive, massive winners. And I think that's one of the reasons why a lot of individual investors got so interested in these stocks, because they saw the potential for these to put up these massive kinds of returns. So the question is, if we're looking today and we're looking at the mining stocks year to date, and they put up pretty good performance, but they started lagging recently, a lot of people are asking the question, is this another opportunity to buy them ahead of what could be a potential bull cycle? And what is causing the recent underperformance that has just recently started to occur? Are there patterns or something in the cycle that we can use to inform our view of when there might be a trading opportunity in these miners? Let's take a look at that. Historically, crypto mining stocks have been very highly correlated with the price of Bitcoin. When Bitcoin's price is rising, crypto mining stocks tend to rise and vice versa. And that makes sense. Crypto miners derive their revenue directly from mining Bitcoin, and when Bitcoin's price is high, they'll earn more revenues than when Bitcoin's price is low. So here, if we look at the chart of correlations between some of the larger crypto miners and the underlying Bitcoin price, we do see this high correlation persist over time. But we also see that there are some time periods where the correlation does break down somewhat. So we've seen the correlation break down, of course, over the past few months with crypto mining stocks being down while Bitcoin's price is up. And we've seen that correlation break as well back in the 2020 timeframe. So the question then is, well, what causes the correlation to break down? And the simplest explanation appears to be the halving event. As you probably know, every 4 years, the amount of Bitcoin that Bitcoin miners receive for verifying transactions and solving cryptographic puzzles to secure the Bitcoin network, those rewards get cut in half. Currently, Bitcoin miners are getting around 6.25 Bitcoin every 10 minutes for the work that they do, and that reward will be halved to just 3.125 Bitcoin in May of 2024. Now, we also had a halving event in May of 2020, and if we go back to that prior cycle, we can see that the crypto mining stocks were underperforming Bitcoin leading up to the halving event, just like we've seen recently. Very interesting to see the underperformance and the lower correlation there between the mining stocks and Bitcoin. It's interesting though, if we look post-halving of the last halving cycle in May of 2020, this is when the mining stocks really started to take off and outperform and become multi-baggers in some cases. So we have seen the underperformance leading up to the halving, but then a massive outperformance after the halving. It's a little bit hard to figure out though if this was because of a strong bull market in Bitcoin and other assets. This was the time period, of course, where we were seeing stocks moon. We saw the whole meme stock craze in late 2020 and early 2021. So it's hard to figure out how much of the outperformance of the miners was because investors got comfortable again with their business model, or if it was just a bull market in everything. But if we're using the prior cycle as a gauge and thinking about what could happen at the next halving event in 2024, in May of 2024, it makes sense that currently the miners would be underperforming, like we've seen recently, but that perhaps there might be an opportunity for the miners to catch up to Bitcoin or even outperform Bitcoin after May of 2024. Now, what this also tells me, if this is my trade thesis, then I probably don't want to be involved with crypto mining stocks prior to the halving. In fact, we didn't see these mining stocks really take off until after the halving event. Now, the market also knows this, right? So it could change this cycle. Last cycle's pattern does not have to apply exactly to this cycle's pattern, and investors may front run the halving cycle, so miner stocks may start to outperform or catch up to Bitcoin before May of 2024. But as a fundamental event, if we're looking at what the halving does to these miners, it creates a significant step down in the economics of the miners, and so that's worth keeping in mind. And of course, like I said, I don't really want to even consider this trade until at least around the time of the halving in May of 2024. I'm going to let the miners do their thing. If they're going to underperform over the next couple months, I don't really want to be involved there. And the price action currently is definitely confirming that. But what do the miners look like on a longer term basis? You might be asking, are miners an opportunity for me to accumulate my portfolio long term? What do I think about the miners' businesses and stocks generally? And that is something that I have a great skill set to be able to answer because of all the work I've done over the past 20 plus years diving into the fundamentals. And so I've spent the last couple of days diving into the fundamentals, the financials, some of the business model changes that have happened here at some of the major Bitcoin miners. And I have an opinion. I have an opinion on whether or not these are good long-term investments, at least for me personally. So let's talk about that. My general takeaway after studying these businesses is that crypto mining businesses are super impressive from an operational perspective, but are not good businesses from a shareholder perspective. And so I don't want to own these businesses long-term because I think they're more likely to destroy shareholder capital over long-term timeframes. And that's really not unique to Bitcoin mining. If you look at other commodity producing businesses, they're just very difficult businesses to run. They have these vicious bull-bear cycles. The producers themselves don't control the pricing of their end product. They're super competitive. They're very capital intensive. They require a lot of capital getting put back into the businesses just to keep them operational. And then you also have very, very volatile margins through the cycle. So trying to figure out what the right valuation is for these businesses can also be very, very difficult. And when you look at Bitcoin mining specifically, they have other headwinds that other commodity businesses don't have. Things like the 4-year halving cycle where their volume gets cut in half literally overnight. And then you also have the fact that the ASICs used to mine Bitcoin get more and more efficient. And so they have to continually be replaced every 2 or 3 years because otherwise you fall behind the competition who are putting in new mining rigs. And so if you look at things like the difficulty level of mining Bitcoin, it just continues to get more difficult over time, which is just another headwind added on top of an already difficult business. If we look at other commodity producers like gold producers, for instance, you can see they vastly underperform the underlying gold price over longer time frames. And this is true in most commodity producing businesses, and most commodity producers just don't generate a lot of shareholder value long term. Of course, you can make money on them in short-term parts of the cycle, and we've certainly seen strong parts of the cycle from Bitcoin miners. But here's the smoking gun. If you look at the actual free cash flow that Bitcoin miners have generated historically, it's been awful. In fact, they've almost never been free cash flow positive through any quarterly or annual cycle in their history. And so you look at all the Bitcoin miners, and really here you can see just negative free cash flows continuously. So how do they fund themselves? How do they stay operational if they're constantly burning cash? Well, they've been selling a lot of stock. If you look at the dilution that shareholders have seen, the share counts of these crypto mining stocks have just grown and grown and grown. I think RIOT has sold something like $1.6 billion worth of stock into the open market just in the past 4 years or so. So you're continually getting diluted as a shareholder. So these Bitcoin mining businesses are not only selling most of the Bitcoin that they're producing each quarter, they're not getting to HODL most of their Bitcoin they're producing because they have to fund operations. And then on top of that, they have to continually buy more and more mining rigs to replace the mining rigs that are becoming obsolete. And so that requires a lot of capital. And they've been funding that capital by selling more and more stocks. So you can see that here in the chart of the share counts of all these companies, which has just been parabolic, basically. At some point, they may not be able to sell stock anymore. That may come during one of the more difficult bear cycles at some point, in which case you're likely to get significantly diluted if they're having to raise capital at the worst parts of the cycle. That's often what happens with a lot of commodity producers. But, if we can dive into the financials here, you can see currently a lot of the margins, particularly if you look at something like gross profit margin for mining, if you look at the revenues received from Bitcoin and energy credits and you subtract just the electricity costs and facilities costs it takes to run them, they're really, really healthy during bull parts of the cycle. Certainly during the top of the cycle, some of these miners were earning anywhere from $1,000 to $2,000 per quarter per miner. And so if you annualize that, maybe they were earning somewhere between $6,000 and $8,000 per miner back in the heyday. Today, with a pretty healthy Bitcoin price, the gross profit per average miner for RIOT and MARA and CleanSpark and some of these others appears to be somewhere between $400 to $500 per quarter, or maybe around $2,000 annually per miner. Now, this is, of course, before considering overhead costs like payroll costs and your management costs, things like that. So we're not looking even at SG&A yet, but these miners can produce positive gross profit. And even after subtracting some of the overhead costs, you can get to pretty nice, adjusted EBITDA margins. That's what a lot of these companies present. They've been anywhere between 40 to 60% EBITDA margins in the best parts of the cycle. Of course, they have also been negative at different parts of the cycle, but right now, pretty healthy adjusted EBITDA margins. But, EBITDA excludes things like depreciation costs of the equipment. So it doesn't even consider the cost of the upfront equipment. Now, if we look at the equipment itself, when we look at the returns, a couple of different ways to look at it, but right now, MicroBT's M56S, which is what RIOT has been putting in hundreds of millions of dollars of orders for, those cost about $5,000 or maybe just north of $5,000 per rig. And RIOT and MARA have been depreciating these over a 2 to 3 year cycle. Now, maybe some of them can last a little bit longer if they upkeep them, but from an accounting perspective at least, they're assuming these things become obsolete within 2 to 3 years. I give them a little bit better credit here and assume maybe they even get some resale value. And in that case, you can get to a positive return on capital. Now, if you include your cost of capital, if you're running a DCF calculation with, say, anywhere from 10 to 15% cost of capital, right now, even with current economics, you're probably looking at a negative DCF value, so destroying value for shareholders there. But, if we're just looking at a pure calculation of what's the total gross profit and resale value over time, versus the upfront cost of the mining rig, and smooth that return out over the life of the equipment, you can get to a positive number. But it's not going to be very large. Maybe 1% return on capital for buying a mining rig and operating it over time. We could play around with the variables. If Bitcoin's price goes up a lot, this number, of course, can improve, or during a bear part of the cycle, this could be 0 or negative. Your miners might be unprofitable, which has happened in the past. So, right now, again, we're giving them a lot of credit. The halving is also coming up in May of 2024, and that's going to cut the gross profit of each miner down significantly. They're going to be producing half as much Bitcoin with the same amount of energy. So, I assume at least a little bit of a step down in the economics next year, and this could probably be even worse. We can also look at other sites that calculate miner profitability. The previous gen of miners like the Antminer S19 Pro, a lot of which are still running, it's saying today that this thing is barely marginally profitable. Some of the newer miners like the M56S that I just talked about, this site is currently estimating just under $1,000 per year of profitability. Again, that's not even factoring in the Bitcoin miners' management costs, payroll costs, etc. This is just purely on the miners themselves, on the actual rig. And they're estimating about $1,000. Again, I think looking at RIOT's financials and MARA's financials and a few of the others, it does look like it's a little bit better than that, maybe as much as $2,000 annually. But it's going to get cut down significantly next year. And if we go into a rougher part of the cycle with lower Bitcoin prices, this will also take a hit. But, looking at it now, maybe a marginally profitable business to run Bitcoin mining rigs when you include the overhead, and certainly if you include things like capital costs of the upfront costs, it's going to be a very marginal proposition at best, if not capital destroying at worst. And that's, again, I think why we see the negative free cash flow over time and these miners having to sell almost all the Bitcoin they produce and having to sell stock just to keep these businesses afloat. So you do look at the balance sheets and you say, well, they're not terrible balance sheets. It's not like they're taking on a ton of debt to run these operations because they are able to sell stock, at least for now. They do have a couple $100 million of cash and a couple $100 million of Bitcoin at market value on these balance sheets. And so they do have, positive book value as well. But again, a lot of that is just coming from the fact they've been selling so much stock. And if they are not able to sell stock, or they choose not to sell stock at a certain point, if they decide to try to do shareholders right, then the negative free cash flows will mean that they'll have to sell the Bitcoin in the balance sheet. That book value could deteriorate from here over time. And so, if you look at where these stocks are trading from a price to book value level, they're trading somewhere between 1 and 2 times book value. And I could argue they should probably trade for less than 1 times book value because book value is likely to get destroyed over time, at least through the longer term parts of the cycle. But currently today trading at 1 to 2 times book value, and that's probably a reasonable level, although again, I could argue lower. And I think just generally these businesses are going to be tough businesses to make any money in as shareholders over long-term parts of the cycle, because if they can't generate cash flow, they won't be able to pay dividends, buy back stock, or deliver capital back to shareholders. They may be able to keep pace with the number of mining rigs, or maybe even grow the mining rig fleet just by selling more stock or selling Bitcoin at the top of the cycle. But, just generally the miners don't seem to be very profitable. And again, the business tends to get more and more difficult over time. The other interesting thing about Bitcoin mining is that unlike something like crude production, where the producers can pull back on supply and actually affect the price of crude, with Bitcoin, the financial supply and demand far exceeds the actual amount that miners are producing. In fact, if you look at the annual volume that miners are producing today, it's basically only 1 or 2 days worth of financial trading volume on Bitcoin exchanges. So the amount of Bitcoin exchanged on exchanges every day from traders, it far exceeds the amount of Bitcoin produced in a given year, just in 1 or 2 trading days. And so, what Bitcoin miners supply into the market really doesn't have much effect on Bitcoin price. 93% of all the Bitcoin out there has already been mined, and less than 2% today of all of the Bitcoin is being produced this year, and that'll be less than 1% next year. So the miners just really don't have the ability to affect the underlying price like some other commodity producers do. So they're at the whims of the overall market and what Bitcoin price does. And that's also why, if we look at correlations, I don't know if it really matters for us to dig into slight differences between any individual Bitcoin miner, because at the end of the day, they pretty much trade as a group. They trade correlated with the underlying Bitcoin price, although sometimes, like I mentioned, they will decouple a little bit during the cycle when there's a halving coming up. But overall, they're pretty much going to do what Bitcoin price does. When Bitcoin price goes up, they'll probably rise for a while. But throughout a longer term cycle, you're going to have downs in the cycle. And so you're almost certainly going to see value destruction when that part of the cycle comes for these miners. So ultimately, I think you're facing a losing proposition as a shareholder. That's my general takeaway. We could jump into more specifics on the financials here. I have compiled some of the financials and looked through gross profit and EBITDA, looked at free cash flow. We can look into these financial statements and see the negative free cash flows. Just looking at a basic cash flow statement, some of these miners, you can see negative operating cash flow, and then even worse cash flow once you consider the purchases of CapEx and the deposits they're putting down on equipment. You can see all the proceeds that they're using, the proceeds from selling stock to be able to fund this CapEx. That's the only way they're keeping these businesses afloat. So we can talk about some of the details. If you've got questions, happy to do a follow-up, happy to dive into any details. But if we're looking at the bigger picture, again, I think these are going to be tough from a long-term perspective, but potentially some opportunities in the short run. So hopefully this was helpful. If you've got any other follow-up questions, definitely let me know in the comments. I'm sure I missed some things, just trying to be as helpful as I can without going too deep into the weeds. But if you're interested in a fundamental analysis toolkit, diving into financials and doing basic stuff with modeling and valuation, I do have a boot camp that I'm going to be doing next year in 2024, so stay tuned for that. But also, if you want to get a flavor for fundamental analysis, I'm going to link my free hedge fund playbook in the description below. And like I said, let me know in the comments if you have any follow-ups, things you want me to look at, questions, concerns, and hope you have a great week, everyone. And I will see you in the next video. Cheers.